Hello, everyone. I hope you're all good.
Hello. Hello.
Good afternoon.
Hello.
Okay, today we're going to continue our subject related to the capital budgeting. Last time I introduced you the expansion of the project, but today I'm going to deal with replacement of the project, how to estimate the cash flow projection with replacement. So coming to the replacement issue, the replacement of the project analysis occurs when a firm must make some decision whether to replace an old existing asset with a newer, efficient, or better equipment. So the purpose of doing so could be the reason to improve the quality of the production, to reduce the cost, and maybe to increase the number of the units you produce to sell more. Because if you reduce the cost and improve the number of the sales, that will directly affect your profits. That will increase your income. So this is the main reason why the company was initially established. So when there is a replacement decision, the relevant cash flows expand to consider decision of the replaced asset incremental depreciation expense, like old versus new depreciation, and incremental cash flows, the cash flows from old equipment versus new equipment. We're given some formulas that we need to consider in projection of the cash flows. First of all, any projection of the cash flow, in any estimation of the NPV, you need to know what is your investment cost and you need to estimate the cash flows. It is the similar what we have done in cash flow projection in the expansion project or new service or products in the new market. But replacement project with one difference is that you're just getting the incremental value, which means that you're getting the difference between cash flows of the old equipment and the cash flows of new equipment. This is the difference. So when you estimate the investment cost, how much money you spend to establish a certain project, like how much money you need to replace existing old equipment with a new one, is with fixed capital investment, change in net working capital, the net working capital investment, plus, the subtraction. Why it's a subtraction? Why we need to subtract something from the sales, something from the investment cost, is called sale of the old equipment. So when we use the new equipment to replace the old one, we need to do something with the old one. We sell it, and the money we receive it, we just substitute, we just remove it from the investment cost. If this was 100,000, let's say, and this is for 20,000, we sold it. So 100 minus 20, which means that we didn't incur investment cost of 100, but in general, the net incurement of the investment cost would be 80, like 100 minus 20. So if you sell something of the old equipment, if that sale is greater than the book value of the old equipment, if let's say the equipment that you're selling is 5,000 or 20,000, and the book value is 2,000. This is sale, and this is book value. If this is greater than this, then you have to pay the tax for it, because you are making some profit, because the book value is the real value of the equipment. But when you sell it, it's the market price is higher than the book value, so you're making the profit. But if the vice versa, you are not paying the tax, but instead you're receiving some tax subsidy. This is how the investment cost should be estimated. Then second step, you do the estimation of the cash flows. It's just change in sales, like sales, the difference between old and new, and some cost expenditures, the change again, and it should be to get the earnings before tax, okay? And plus, you're adding the depreciation here, but change in depreciation. So the change in depreciation should be considered as well. So this is, and we've got the terminal non-operating cash flow in here. As you can see, that sale of the salvage value of the new equipment minus salvage value of the old equipment. So if there is a salvage value, you just get the difference plus net working capital. And that difference should be taxed because you're making some gain when you sell some of the equipment and you get the difference, okay? If the salvage value was zero with the old equipment, then there's nothing to do with the old one, but you just deal with the new one. If there is something new, then you just apply this formula. So let's see how it works in a real case, like with the example which is given in the slides, in the next slide. So replacement project analysis, an example in here. It says that suppose the Michael would like to replace an existing printer with a new high-speed copier. Okay, we need, so we are having some publishing house, some printing house, and we installed that printer for 15,000. Okay, the old one. Okay, we installed for 15,000. The printer is being depreciated using the straight line basis, assuming that useful life 15 years. If this so, that it means that depreciation, annual depreciation will be equal to 1,000, like 15,000 divided by 15 years would give you for each year 1,000 of depreciation. So every year it will be depreciated for 1 year, 1,000. If existing printer is not replaced, it will have a zero market value at the end of the useful life. So there will be no salvage value, okay? At the end, when you finish the project itself, at the end of the 15th of year, the salvage value will be zero. However, let's say 10 years passed, you decided to purchase. So this is the timeline. Okay. This is year 0 and 15 years. Okay. This is timeline. In here, when the 10 year passed, it's passed. Okay. You decided for the remaining 5 years, to replace that old equipment with a new one. And the reason was that is to cut the annual operating costs. So the price of the new equipment is 24,000 and the life will be 5 years. So the remaining 5 years, the new one. And this is old. Okay. So, and we know that the whole, if it was old, it was 15 years and 15,000. That means each year 1,000. Okay. But this is 24,000. So for the remaining 5 years, what will be the depreciation equal to 1,000, 1,000 accumulation, maybe 5,000 total. So we need to estimate, whether the replacement of the new copier with the old one will be beneficial for us. This is the idea actually, but let us read what is said more. So we'll cut the operating cost from 14,000 to 8,000. So the reason to replace the new with the old is to just to cut the operational cost by 6,000. It is estimated that the new copier can be sold for 4,000 at the end of the 5 year, and is estimated salvage value. So the old printer's current market value is 2,000, which is below. So we will be able to sell our old equipment. We know that the book value of the old equipment now is equal to 5,000. How did we estimate? Is there any idea? We are in the 10th year. The book value of that equipment is 5,000.
because we have extra 5 years of
Yes.
life of the printer, and depreciation for 1 year is 1,000. So
Very good.
multiple one.
Very good. Very good. Thank you so much. Thank you so much, Ali. Now, book value is 5,000 for the old one, but salvage value of this equipment is 2,000. Salvage value of this equipment is 2,000. What do you think? Do we have to pay the tax when we sell it for this?
No. We should have a tax subsidiary.
Yes, very good. So because the salvage value is much less than the book value, we do not make any gain from the sale, even we are losing. So we need to get some subsidy from the government for this issue. Okay, this is good. This is what we understood. And if the new copier is acquired and the old printer will be sold to another company. Let's move further. The company's marginal federal plus tax rate is 40%. The replacement copier is slightly below the average risk, and the net working capital requirement will also increase by 3,000. So NWC will be 3,000. By an IRS ruling, the new copier falls into a 3-year modified accelerated cost recovery system class. So if you remember from the table which is given in the book, here, so we're going to use these percentages, but in the slides, they have already calculated. So we don't have to calculate. So compute initial investment outlay, this is what we're gonna do. Operating cash flow as well, and terminal non-operating cash flow. And we should determine whether the project should be accepted using the NPV analysis, whether we should replace or not. This is what we should determine. So we go for here, I'll just erase it. Okay, just erase it. Okay, I'll start from here. The price of the new equipment, the new printer that I'm buying is 24,000. Okay, I just put it directly here. The net working capital is 3,000. All the information is given here. 3,000 here, and 24,000 is here. Okay. And salvage value of the old equipment, that for how much we'll be able to sell it, is this 2,000. It's given as well in this slide. We just put it. Where is it? Yeah, 2,000. The old printer's current market value. This is how much we will sell it for. Okay. Then that means we have this part of investment outlay. Okay. Fixed capital investment plus net working capital. This is what we used to do in expansion. Now we're adding one more variable, which is subtraction of the sale. However, when we sell the old equipment, there should be some gain taxed if there is a gain. There is no gain, so we don't tax it. So salvage value, which is 2,000 here, minus book value, 5,000. Okay, and there's a minus 3,000, which will be kind of subsidy. So we don't pay, this is not a cost, but it's a help from the government. So and the tax is given, if I'm not mistaken, it's 40%. So this part, I calculated in here. It becomes minus 1,200. How did I do it? If I open it, 40% is the tax, 2,000 is the sale. So this is salvage value, but not in here, sorry. And this 5,000 is this one. And this 40% is the tax. Okay, this is how it works. Then we calculate everything and we get minus 1,200. So we do everything in accordance with the formula. So fixed capital plus net working capital minus sale plus this amount. So plus this minus. So, and that will give you $23,800. This is our investment outlay. Great. Now we need to fill up this table. We need to fill up this table, sales and so on. So what we will do, starting with the sales. Actually, in this project, replacing the new with the old, there is no any sale increase or decrease. So the sales is not affected. So incremental value between the new and the old sales is 0. There is no change. So I put all of them 0. But my concern, I'm saving the money in here. I'm saving the money. My old expense was 14,000 and the new one is 8,000. I'm saving 6,000 from each year. So in here it says, I cut the annual operational cost from 14 to 8. So my saving is 6,000. So which means that new one, 8,000 minus 14,000. That will be minus 6,000. Minus 6,000 in Excel in cash operational expense cell or row means it's a saving amount. And it is the same for all years. This is much we are saving. We said that for the remaining 5 years, for the old equipment, it was 1,000. And depreciation of the new equipment is given in here. 7,920, 10,800, 3,600. $7,920, 10,800, 3,600, 1,680, and the last year is 0. Now, I need to calculate depreciation of the recovery system, the difference, incremental value. So what I do, just new minus old, new minus old. Okay, do you have any questions up to this point?
Sorry, what does RDEPR mean? Stands for?
Recalculated depreciation.
Okay.
Okay, recalculated depreciation. Now the turn is yes, yes.
How did you find new depreciation? Is it given?
Yeah, it's given in the slides. In the slide, it says this the depreciation. In the question, it will be given to you.
Okay, thank you.
Okay, they give you. Okay, it could be straight line or it could be another way around. Now, to calculate the earnings before interest tax is the same. Sales minus cost minus depreciation. And we get this. And for all years, we repeat. Then we adjust the tax rate, which is 0.40 times and we calculate operating cash flow after the tax. This minus this for all years. And we need to just re-enter the depreciation back. We re-enter the depreciation back. Okay. We re-enter the depreciation back. Did I enter depreciation correctly?
No.
No. So I should enter this one, the recalculated one.
Yep.
So there is a mistake that I made it. And my operating cash flow after tax is this plus this. This is what I get it. And I just drag down here everything, investment costs, my cash flow. But now let's see how the terminal non-operating cash flow was calculated. Okay. We said anything we sell. So if you see the formula, come here. Here the formula. salvage value of new equipment minus salvage value of old equipment. We know that there is no salvage value of the old equipment, which is 0. So this is 4,000, this is 0. Okay, there is nothing. At the end of the 5th year, it's 0. And the book value of the old equipment at the end of the 5th year, at the end of the 15th year is 0. And here is 0. So we have only this amount, and this amount. Okay, these are 0, and this is 0. Why 0? Because it said its market value is 0 in the question. Here. Of 15 years and no salvage value. So at the end of the year, 15th year, it will be 0. Book value 0. But in the 10th year, the salvage value is 2,000 and the book value is 5,000. It's totally different, but we are talking about the 15th year. This is what we are concerned about more. Now, what I do here, first of all, it says that we are selling for 4,000 at the end of the 5th year, the new project. So we sold it, we sell it for 4,000 plus net working capital, which was 3,000 minus, because as we selling it for 4,000, it needs to be taxed. It needs to be taxed. And the tax is equal to
0.4.
0.4 times 4,000.
Yeah.
This is how I do it. Okay. And what I do at the end, the last cash flow is shown that it should be added with the terminal non-operating cash flow in order to estimate the NPV. And our NPV, as you can see, is negative. And as a support for the IRR, IRR is less than cost of capital, then we can say that the project is not feasible. So it's not a good idea, it's not a good decision to replace the project, to replace the old equipment with the new, even though you're saving 6,000. What if, let's say your sales increase by 300? Your sale increased by 300 every year. Let's see how it will change. Does your NPV have, or let's make it more realistic, 1,000. Your sale increased by 1,000 each year. It's just assumption, okay? I'm just playing with the numbers. My NPV became positive. So in order to accept the project, in order to come up with a decision to replace the old equipment with the new one, not only the cost should be reduced, but the sales should be improved as well. This is the idea. But basically it's 0. So our NPV negative. So decision is to reject. Okay. Up to this point, do you have any questions?
Sorry, Professor.
Yes.
I didn't get the idea of recalculating of depreciation with comparing the old one and new one. Can you explain this one?
Okay, sure. Now, the old depreciation, it's for the old equipment. Is that clear with you now? The old depreciation, it's for the old equipment.
Yeah.
I will write it here. Old equipment is 15,000. And each year, annual depreciation will be 1,000. Okay, this is for old equipment. New equipment, depreciation is 24,000. And it is annual depreciation with macro system.
Yep.
and it follows here, 7,000 and so on, 7,920, and I'll put 3 dots here. Okay. Now, as there is replacement, we need to replace the depreciation. So in replacement, we are getting the incremental value, the differences between new one and the old one. So the difference between the first year, this and this, is 6,000. Difference between this and this, 9,000. And it should be done for all years. Okay? Is that clear?
May I ask you one more question, Professor?
Yes, sure, of course, not one more, many questions should be.
Why do we need terminal value of cash flows?
Why do we need it? It should be included in cash flow projection, because at the end of the year, you're selling everything. And the money that you receive, you are adding to estimation of the NPV, because you receive this money, but this money is not coming from operation. This money comes just from the sale of your project, we can say. And you want to see how it will be affected, because this money doesn't go somewhere, it will come to your project.
So you added to the last cash flow, right?
Yes, that's the reason why I'm adding to the last cash flow.
Thank you.
Sorry, Professor, one more question.
Yes, of course.
Why we add recalculated depreciation when we calculated earnings before tax? Because depreciation is an expense, it should be deducted.
Yes. Just let's say this is part before this yellow part. This is income statement. Okay. This is green part is income statement. This green part is income statement. And we are using depreciation. It's one of the IFRS and the GAAP rule. It should be included in deduction, because to help you to kind of reduce the taxes, because the equipment that you're using is being depreciated and it's a cost. However, it's a non-cash item. So being as a non-cash item in cash flow projection, you should add it back to the operating cash flow after the tax. Depreciation is being a non-cash item. It is treated as a cost while estimation of earnings before tax. Then after the payment of the tax, when you derive the operating cash flow after tax, you add it back with the purpose to estimate the cash flow for estimation of NPV. Okay? Does it make sense?
Yes.
Do we have IRR?
Yes, IRR here at the end. IRR and the NPV.
But when we calculate in real life, do we need to take all sales that company generates and then do all these operations?
One more time your question, please. I didn't get it.
When in real life we estimate the same thing, changing the equipment, do we need to take all sales the company generates or only relative to this equipment sales?
Only the relative to this equipment sales, only the relative one. You do not, you only replacing that equipment, old with the new. If you're, let's say, look, if your old equipment, let's say we have old equipment and new equipment. If sales, I'm talking about the sales, okay? Let's say 5 years. In the first one, you generate 3,000 each year, approximately, okay? How many, let's say, bread you will produce, or if you're establishing a chicken farm, how many eggs will be produced by chicken every year? You're just making an estimation with the new fertilizers. But replacing this old equipment with the new, it will help you to improve, let's say, by 6,000. Okay, and the difference, it will be incremental value. Incremental value, the difference. So which is 6 minus 3,000. And this is how much you're going to sell for. Okay, but in the income statement is mentioned the price with the quantity. But in here, in our example, it's 0. Why it's 0? Because replacing this equipment only improves the efficiency of production. It reduces the cost only. It doesn't increase the number of the sales. So it doesn't increase the number of the production of the printing. That's
Okay,
why we've
got
got
it.
the 0. That's why we've got the 0 here.
But may I ask you a little
Sure.
bit, maybe a relative question, but what if we take this equipment for rent, not owning? And when we take it for rent, we don't pay for depreciation
Yeah,
because
you
it's
don't
not
pay for
allowable.
depreciation, but instead of depreciation, you have what? Rent expense.
Yes.
It will be out of business expense. I mean, if you buy equipment, you can like sell it after the I don't know 5 years with a salvage value, market price. But if you are renting an equipment, so then your cash is going to out of the business. So it's not
Okay.
good.
Yes, it's right. But what do we need to put into the depreciation? You just zeros?
Yes, it's 0 because the depreciation is not related to you. The depreciation is related to one who rents you.
Yep.
To the land, okay, to the owner of that printing machine.
And where do we need to put rent expense in this case?
Just after the sale. Just after the sale. The order is not that much important, but it should be after the sale in order to derive the earnings before tax. The idea of the income statement is just revenue minus expenses. How the expenses are put. Yes, it's a method according to IFRS and the GAAP system. However, it's not a matter because in any way you are just subtracting from the sales to get the earnings before tax. So you can make estimation if you rent it, let's say, but in real life you need to get the real numbers. How much is the rent, and how much will be the depreciation? Whether it's straight line, whether it's who is determining whether it should be modified, accelerated cost recovery system or depreciation straight line? It is determined by the system of accounting, which country is running. Like if it's Kazakhstan, they are maybe using IFRS with the GAAP mixed. So you can use both mixed, like changing maybe from depreciation straight line to max. But if it's in US, you have to use whatever is given for each industry. So the GAAP is more a bit rule levels, I mean, more bit complicated in contrast to IFRS system. Okay, another task for you, I would like to give you an activity to do now. Do the same example, but change this depreciation for the new equipment, make it straight line depreciation, and see how the NPV will change then. If you finish with your questions, then I will ask you to do the following. Change the depreciation method for the new equipment. Don't make it in accordance with what is given in the slides as markers, but make it as a straight line. Am I clear with the question?
Yes.
Yep.
Okay, do it now. And while you're doing it, I will prepare an activity file in Moodle where you can upload your answer. Okay, let me just put it like this. I'll share it again, don't worry. For those, this file is available on Moodle. This file is available on Moodle. You can download
Can
it.
you download it? And
Yes, of course, you are free to download. Just download it and change the proper numbers in here and see what happens to NPV and make your decision on that. Make your comments.
Professor, where can we get the presentation, or it's impossible?
The PowerPoint slides are available on Moodle as well. Just a second. Here's the capital budgeting, the presentation. And today we are dealing with this. So this file you can download now and work whatever I asked you to do now. So while you're doing it, I will prepare for you and activity part on model.
Depreciation for 4 years. Yes,
No, the project is how many years?
I don't remember. 5 or 4.
Slides. Check the slides. It's 5
15.
years for the last 5 years.
Could you please share the slide?
Okay, let me share the slides better then. I'll share the slides. Wait a second.